This panel specifically, we're going to talk about our focus portfolios along with SMID and mid-cap.
Sure. Hi, Michael Barron. I'm the co-portfolio manager at Barron Partners Fund, which is an all-cap focused portfolio.
Hi, I'm Neal Rosenberg. I am the co-manager of Barron Growth Fund along with Ron. I've been with the firm for 18 years.
Hi, I'm Andrew Peck. I've been with the firm for 26 years. I manage Barron Asset Fund, which is a mid-cap growth-focused mutual fund. I'm also the co-chief investment officer, along with Cliff Greenberger.
I mean, at this point, the process will be you raise your hand, somebody will bring a microphone over, and we're just going to open it right now to questions. I know there's questions out there. Yes, sir.
Is anyone from the lab?
Sure. So the question, for those of you who might not have heard, was essentially checking in on Guidewire, which is a company whose CEO presented at the conference several years ago, and the stock has really done quite well this year in particular. I think it's up almost 100%. So I guess taking a step back, for those who aren't familiar, Guidewire is a vertical software company that's focused on providing solutions for primarily property and casualty insurance companies. And it's a stock that we've owned since its IPO almost 10 years ago, I think. The stock had not candidly performed that well for a period of time. And really the primary reason for that was the company's original incarnation was as an what's called on-premise software provider for the insurance industry. And they transitioned their basic product offering to something called a SaaS model, software as a service, which is the type of software that's sort of much more prevalent and in vogue, so to speak, these days. During that software transition, the company's near-term profitability was penalized. The stock didn't perform that well in the market as a result during that period of time. But sort of fast forward to the last 12 or 18 months or so, that transition from being an on-premise to a software as a service company has been completed. The company is excelling as a result of that. It's both on the top line, its revenues has accelerated, but also, perhaps even more importantly, its profitability has accelerated quite meaningfully because the investments that it had been making have now, essentially been monetized. So getting directly to your question, the short answer is yes, we are still very excited about it. Part of our thesis when we invested initially in the company almost 10 years ago was that Guidewire would be essentially a category killer in a very large market as the first and best positioned software company focused on providing these next generation solutions to the property and casualty industry. They've become the dominant market share taker. We think there's a lot more market share left for them to take, and we remain excited long-term investors in the company.
Thank you. Are there any concerns with regard to Tesla with Elon stepping away for 2 years?
Sure, I'll grab that one. It's kind of funny, I was thinking about that. I think it was barely 2 years ago, we got a very similar question where people would say, is there a concern with Tesla and Elon with what he's doing with Twitter and, rebranding it now to X? And you can ask that question multiple times throughout the journey. He's done a lot of things. Tesla, SpaceX, XAI, Twitter or X. And what he's proven is that he's able to do it. And the way he's able to do it is because he has a great team around him. When we go out and visit with him and the executives at Tesla, it's not just Elon. Elon is extraordinarily important. It's his mission, it's his vision in terms of what all these businesses can become. But he's proven to show that he can attract a great setup around him who actually do the day-to-day, who actually can deliver upon the mission. And what I think is often overlooked in terms of what he does with these various businesses is they're synergistic. The aspect in terms of Tesla and SpaceX, you learn about how to manufacture one to the other, different materials that can be used. When you go into something like X or XAI, you're starting to learn about artificial intelligence. Where do you do artificial intelligence in terms of driving vehicles, robo-taxis, and driving autonomously? So there's a lot more synergistic plays throughout his companies than I think most people give him credit for. In this next little pivot to the government, I don't know exactly how much time he's going to be spending in the White House or in what they call it, the Winter White House down in Florida. But his passion is really his businesses. And I think what happened, unfortunately, look, he's always said that he does not want government to be the enabler of things. I remember having a conversation with him a while ago talking about how government's very important. And he said, no, we don't want government involved. We don't really care about the tax credits and all that kind of stuff. That enables inferior products to do well. And instead of being government out of things, government has become an inhibitor to what he's trying to do. And I think now when he's going to DC and the government, he's trying to keep government at bay, letting innovative businesses and entrepreneurial businesses really operate independently.
Question back here.
Yeah, I asked the same question of the small cap group. We're kind of in a changing environment where Stripe isn't public yet, SpaceX isn't public, Snowflake goes through DPO instead of IPO. And I had asked if Barron was looking to do more of these privately held companies, similar to what Ron has done with SpaceX. And the small cap manager said he didn't think that was appropriate in a mutual fund, which is a little odd with what Ron's doing, but I was curious what you guys have to say.
Do you want to? I'll
Why don't you start and I can jump in from a small cap perspective.
I'll start. What I would say, and I heard some of the comments from the small cap panel on this topic. I think from our perspective, our primary mission and obligation to shareholders, I think, is to invest in great publicly traded securities. I think that in certain unique instances, the SpaceX example, perhaps being the best one, as a result of sort of what we're doing in our sort of day job, finding great public companies, we sometimes come across the opportunity to invest in, uniquely positioned private companies. But the sort of bar or threshold that's necessary for, I think, all of us, and certainly Ron in particular, to get comfortable investing in a private company is that much higher, if you will, because there are obvious liquidity issues that come with owning private companies and publicly traded mutual funds that have daily liquidity. So to the extent that we come across other opportunities that are unique and compelling like that, I think there might be a little bit of appetite, and it probably differs from fund manager to fund manager, but I wouldn't expect it to become a much larger portion of our business.
Yeah, I concur, and as from the lens of a smaller SMID cap strategy, I think when you think about the maturity of a still private business that would come or be valued at a market capitalization that would be appropriate for our strategy, that's something that is particularly, very early, likely pre-revenue, and therefore carries a risk-return profile that's probably inconsistent with what we're seeking to deliver. When we look back, at the positions that we've bought or added to in our strategy over the past 5 or 10 years or so, I would say that less than 10%, probably less than 5% of them have come from the new issue, have come via that new issue process, an IPO process. So from our perspective, we don't believe that, if the implication of your question is there were fewer, or a corollary of your question is there were fewer IPOs coming to market, is that going to hamper your idea generation? We would say that, less than 10 and probably less than 5% of our ideas in aggregate over the last decade have come through that process. We much prefer, a bottoms-up organic, fundamentally researched idea generation process, really driven by, our large and growing team of analysts.
If I could add just one more quick thing, I think part of the reason for, the interest among, many sort of mutual fund and sort of non-traditional players in private market investing over the last handful of years has been driven by the fact that the IPO window, as they call it, has essentially been closed for the last several years since COVID, meaning the number of companies that have come public, has really, been meaningfully below trend line for a variety of reasons. And I think the expectation is that coming into the new year, now that the election is behind us, and given that the stock market, despite some hiccups, is near all-time highs in many regards, I think there's an expectation among a lot of capital markets, bankers and the like, that the IPO window will open during the first quarter of next year. So if that happens, I would expect a lot of those private companies, some of which you referenced, to be coming public and be sort of less of an issue or concern.
Thank you. Question over here.
Yes, this is for Michael. Once again, I thanked you last year. I'm going to thank you again for the 9x return on the Barron Partners Fund since we've been invested. But one of the things that I'd really like to pick up, which was already discussed, is how do we get more involved in XAI and SpaceX? I've looked at what you own in partners. I've looked at what's in the Focus Fund, and that seems like the better avenue. I know it's in some of the other funds. I looked into the Cayman's XAI, but the minimums were too high for me. So how do I get more exposure? I've heard your father there, SpaceX is going to double, triple, 10x over the next few years. I want more of that exposure. What fund do I go to try and get it?
You're right. You're in the right funds. So Barron Partners Fund is right now at around a 12% or 13% exposure to private companies, and the vast majority of which is in SpaceX. Barron Focus Growth Fund is a little bit lower in terms of overall, but they have some XAI, I believe, and some SpaceX. So we have explored some private vehicles, but it's for a different client base than typically it's at our conference here.
Back here to the right.
And so just to add to that, that's also a limit by the SEC. So we have to stay below 15% in each of our public funds in private securities. And that can't even be passively breached. So if that goes up, we'd have to sell it. So we really need to stay below that 15%.
Back here.
Good morning. A question for Michael is a two-part question. First is how your financial modeling might be taking into account the possibility for EV credits possibly going away. And then the second question is, given that Elon obviously is very partisan and very outspoken, are you seeing any fallout on the Tesla demand happening right now? Thanks.
Sure. So
I got that question before.
I'll do it in the order yours given. EV credits that going away, related to that story I was telling earlier. So it actually related to the EV credits. I remember we started buying Tesla between 2014 and 2016. And it was a weekend we were talking about, something was going on with the government and I sent an email that said internally, hey, you should be very careful here. You need the government support. You need those EV credits. And my dad, in his great wisdom, forwarded it on to Elon, and they get an email back from him on probably a Sunday morning saying, Michael, you don't effing know what you're talking about, which is great. But that was his mentality. He does not want government to really be in business. He does not want them to be saying, who's going to be the winner. When you give EV credits, it'll allow inferior products to remain viable. That's not Tesla. Tesla, the great thing they did this past quarter is lower the cost to produce. Everyone's focused on the top line. Everyone's focused on the amount of vehicles that's being produced, how many vehicles are going to be produced this year, next year, and what they can sell them for. The cost is where you should be focusing, and they're taking a lot of costs out each and every year. 1,700 came out this past quarter. Expect more to come out in the first half of next year as the new vehicles come on, and eventually the next generation, even more costs coming out. The traditional guys can't compete where we are today. No way will they be able to compete going forward. Allowing the government to give you 1,700 over might be, it might sound great today, but over the long term, Tesla will be better off if government's not involved. Next, in terms of Tesla demand and any fallout from his alignment with Trump, I think it's kind of too early to tell. But I think if we ask the question right here and say, who voted for Trump, who voted for Kamala, you'd probably see half the hands go up, half the hands go down. Nothing you can do in this country is everyone's in alignment. So I think at the end of the day, people care about the product and what it does, and don't care about his political views.
Question over here.
Hi, good morning, thanks. I've been a happy shareholder for probably over 30 years, so don't get me wrong. And I own all three funds that you represent, but I've been concerned that the 1, 3, and 5-year returns of all three funds have not only trailed the averages, but trailed comparable small and mid-cap funds. I also noticed that the number of companies and the companies themselves really don't change very often. I understand that you're long-term shareholders, which you look at as 10 years, but I've been disappointed in the last 1, 3, and 5 years of all three funds, even though I still hold them. So I'd like to know how you gentlemen feel about that. Thank you.
Maybe start with Andrew.
Sure, I'll start, and then maybe the two of you can join in. I guess what I would say is big picture. As I think we have what we consider to be a very distinct investment style and process. We're long-term investors in high-quality, competitively advantaged, secular growth companies. And I think we've gone through a period during the last 2 years in the post-COVID environment in which, very simply, those types of businesses have been relatively out of favor, and instead more speculative businesses and their stocks have been in favor. And so as a consequence, we've seen the fastest growing, generally highest beta stocks outperform within their indices. And I would say we've, having done this for 26 years, and my colleagues having done it for almost as long, we've gone through periods like this, unfortunately, several times in the past, and we've always come out stronger, so to speak, on the other end. I think that the market inevitably moves in cycles in which various sort of types or flavors of stocks are sort of more or less in vogue. It has tended to be the case that in the aftermath of meaningful market drawdowns like we saw in 2022 related to COVID and everything that was associated with that, when the market, all the indices were down 30–40%, there was sort of meaningful sell-off, and then fortunately a meaningful rebound that again started at the beginning of last year. For the reasons I referenced, our types of stocks, higher quality, more stable earnings compounding businesses have done fine, generally speaking, in that environment. But you're right, they've lagged on a relative basis. But I think that's just sort of the nature of market cycles.
Yeah, I would add, just to put some numbers around it, at least for Barron Growth Fund. So I would echo everything that Andrew said, but just to put some numbers around it for Barron Growth Fund. Again, when we have taken a look back at our last 10 years of performance, and actually the same analysis will hold true over the last 20 years, but what we've identified is that over the last 10 years there have been 4 years of underperformance, 4 periods of underperformance. Each on average has lasted 12 months, and we've underperformed over that period by about 990 basis points cumulatively, which is about 870 basis points annualized. And I think we've certainly experienced that over the last 9 months or so in Barron Growth Fund, which I think has impacted the 1, 3, and 5-year numbers. From a forward-looking perspective, though, we followed all of those periods of underperformance by much more significant, much longer outperformance. So our periods of outperformance over that period have lasted for 24 months on average, so twice as long as the period of outperformance. And our cumulative outperformance has been almost 27% over that period, so 2.5 or 3 times the underperformance, which turns out to be 13.7% annualized, or significantly better than the, periods of underperformance. So, as Andrew said, certainly, I think there's a litany of reasons why our stocks have been less in favor, particularly of late, but I think, stylistically, we continue to pursue the same rigorous investment strategy that we have, since the firm's inception, since I joined the portfolio, since we've all, been here, and I think that gives us lots of optimism that our, diligent, rigorous, holistic research process drives, differentiated long-term performance and, meaningful alpha over time.
Question over here.
Good morning, gentlemen. Just a quick question for you. Elon said he wouldn't be taking SpaceX public until it had very predictable cash flows, and now we're, I guess, north of $5 billion in cash. Over the next few months, if the boot of government regulation comes off of Elon's companies a little bit, do we think something's going to happen with SpaceX or Starlink sooner rather than later?
So we have Gwen Shotwell speaking probably in the next half hour, and maybe those questions are better geared towards her. But I think what he's talking about in terms of predictable cash flow is they have two businesses, the launch business, which is relatively unpredictable, and then they have the Starlink business, communication business, which is very predictable. When Starlink, you should be looking at Starlink in terms of, when that's up and running and having more and more customers, that'll be the turning point for it to maybe go public, in my mind. But better question for Gwen.
Question over here.
Hi, good morning. I want to add on to his question about SpaceX and some of the privates that you're in. My question is, there's been some recent capital raises on SpaceX, and you're restricted at 15%, I'm assuming, from the SEC, which you mentioned before.
Correct.
So, obviously, how are you marking that, and how is that affecting that 15% cap? And you mentioned that you may have to get out of some of it to be under that. Who are you selling it to? And is there an opportunity for investors in Barron to be part of that sale that you may have to be forced to do in SpaceX and in AXI both?
Sure.
I'm curious to see how that structure works.
So the valuation is set based on the offering, and we hold it at that price until there's another offering or another discoverable price. So it doesn't fluctuate too much from on a day-to-day basis. We have had to sell once as a result of appreciation. We sold a little bit of stock, and it was facilitated by the company. So we know we don't go to the open market and say who here wants to chip in. But yeah, the company facilitates all buybacks, and it's been relatively easy and liquid.
Go ahead, Lucy.
Yes, sticking on the theme of alternative capital structures, Michael's comment about the 15% limits, I've seen a lot about like this DXYZ closed-end fund investing in private companies like SpaceX and X. Has Barron considered a different vehicle like that for its large base of investors rather than small private groups for these other elements?
Yes. Ironically, we went down a long road with closed-end funds and trying to understand if it made sense to do a closed-end fund and have more of our privates in there. End of the day, we determined it wasn't right. It wasn't really right for our clients. We didn't like the structure in terms of what people are buying in for, what they're paying, and what it sells for in the market, typically at a discount. We think the current structure of the mutual fund structure is more appropriate, but at the same time, we are exploring other structures for our strategies to be more appealing to potential clients.
Kind of a general question, maybe I'll ask it to the panel, is the discussion of AI and the focus that's been on companies like NVIDIA with its multi-trillion market cap. What about us? What about us in the small and the mid-cap size? How do we take advantage of that? I know Cliff talked a little bit about it in the previous panel. Maybe you all have a view.
Sure, I'll take that one.
Why don't you start?
I'll start. So at least from a small or SMID and mid-cap perspective, it has been there's no way that the market caps of the Magnificent Seven or the traditional AI or widely recognized AI beneficiaries is too great to invest in directly. So I think we found several derivatives with which to leverage that AI play. I think a great example that's in actually I think all three funds is a company like Gartner. We think broadly speaking, businesses that have proprietary data models are going to be able to take meaningful advantage of trends in AI. Gartner is the largest provider of syndicated research, both for technology and for business services. They have a vast pool of proprietary data. We think that they're going to start deploying, have begun to deploy AI tools that will allow them to surface compelling new insights from that proprietary data set and expose that to clients. That should have a couple of benefits. One, it will allow them to raise prices because they're more quickly because they're delivering more value. And two, it should allow them to serve a greater number of clients. We think second, the beauty of Gartner's model is that it allows every company to get access to their suite of analysts that become deep experts of technology. Every company in the world, from the largest to the smallest, has to grapple with what exactly AI will do to their business and how it offers risks or opportunities to their business. And the cheapest way to understand that is to subscribe to Gartner for $50,000 a year and get access to their 100 or so analysts that are working on AI. We think, in addition, Gartner's large sales force, amazingly enough, spends, or maybe not amazingly for anybody that's a salesperson, spends 30 to 40% of their time purely on back office, paperwork-oriented processes. We think a lot of that is going to be automated away, both from a scheduling perspective and from a paperwork perspective, allowing them to spend more time selling and therefore enhancing productivity. We think the cost of AI will also leverage the cost of, or decrease the cost of service. And what we like is that Gartner, the manifestation will be faster revenue growth, higher margins, faster earnings growth. It's just starting to show up in earnings now, but it's not widely recognized yet. So we think that while NVIDIA and other large cap or mega cap AI businesses have had tremendous moves, we think the benefits to our portfolio for names like Gartner or MSCI or Guidewire is on the come. I think I would add one, I'd make it one additional point if that's okay. Sure. I think it's interesting. Maybe other people won't, but I think, which tends to be the case.
You're always interested.
Right, tends to be the case. But I think AI, I think this is a great example. The parable of super microcomputer and AI investing is a great argument for the importance of active management. So AI has been an incredible theme, soliciting tons of inbound questions and lots of market momentum. And people have been searching for AI derivative plays at the small and mid-cap level. Super microcomputer has been public for 15 or 20 years, is a business that has negligible EBITDA margins, negligible free cash flow margins, but starting mid-last year, mid-2023, got caught up in this AI hype, saw a meaningful acceleration in its revenue, but still struggled to convert any of that to EBITDA or free cash flow. But the stock caught fire. First quarter this year alone, it was up 260%. The market cap jumped to $60 billion while it was still in the small cap index. And everybody was chasing it, bidding it up and bidding it up and bidding it up. We had looked in the past and believed it just didn't meet our quality standards. Since peaking in, I think the risk would have been, without active management, it was easy to chase this, $60 billion, expecting it to go to 70 or 80 or $100 billion. What's happened since then is, of course, that trade on Supermicro has completely unwound. The stock, since peaking in February, is now down 87% from its high. Its auditor resigned 3 weeks ago, it's being investigated by the DOJ, and I think last week announced that it's not in a position to file its 10K or 10Q. So I think, again, an excellent example of how, active management plays a critical role in identifying, businesses that not only benefit from powerful secular trends, but meet, very high quality characteristics and can generate, compelling, consistent free cash flow and drive favorable returns over time.
We're at the end of the panel. We really appreciate your time. I know there's some other questions out there. Just so you know, my colleagues will be around. You could ask them specifically or talk to one of your sales individuals. They can certainly help out. Once again, thanks a lot for your time, and most importantly, thank you for your business with Barron Capital.